Okay, now let's move on to our next topic, that is a fully prepaid lease. So, fully prepaid leases involves the lessee paying upfront the full amount of the leases. So, we may encounter these mostly in oil and gas industry, technology, aviation, etc. And we have the option to include fully prepaid leases. We recognize ROU asset and we will have no liability. In a finance lease, ROU asset will continue to depreciate using the straight line depreciation method. And for operating leases, since we don't have the liability, depreciation will equal the straight line lease expense with no subtraction of interest expense for the period. And depending on when the payment is made, we have two ways of including fully prepaid leases. One is when the payment is done on the first day of a 2 or 3 year lease. We can use the payment frequency one time and payment frequency one time combination with the first payment date as the first day of the lease. Here we have 1 million paid once on the first day of the 12-month period lease. And here we can see the first payment, and then we don't have other payments. And the liability too, we don't have any further liability. But we do have an asset and it is being depreciated using straight line method. The postings we have, the payment accrual for the first period, and then we have our usual monthly depreciation postings. The second method is if the payment is made before the first day of the lease. So since we cannot proceed without adding a base rent term, we add a base rent for $1. We cannot, this $1, it cannot be less than 1. And then we can add a prepayment term for the amount paid. And then we can activate the contract. And then once the contract is activated, we can do a lease modification. And we can add a reduction. We can add a reduction at the start of the term for $1 to offset the base rent. And then we will have it will be as if we don't have any payment. So in the schedule we can see we have a standard payment of $1 and the reduction of $1. So we don't have any payment and we don't have any liability, but again we do have an asset, and this will be depreciated using the straight line method. And for the posting, we don't have the payment posting or accrual, but we do have the depreciation posting as usual. And even with these kind of leases, where we pretty much manage only the asset, we do have the option to modify it. We can add a supplement if there is any extra payment to be made between the leases, and the leases can be extended. The asset value can be reduced, impairment, and also the early termination. Since we don't have the ability, since we don't have liability, we will have to use the asset casualty instead of termination. So this is an example. We have the base prepaid fully prepaid lease for $1 million, and we are terminating. We are using the asset casualty to end the asset and retire them. So here we have the gross book value is 0, and we are reducing the liability, that is the accumulated depreciation, and our NBV is set to 0 at the end.